The market and understanding what will drive interest in 2023. I'm Jason Schmidt, and this is the Weekly Mail. Over the past several months, waves of rate volatility and changing transaction patterns has had the entire real estate industry running in circles. Rates kicked off 2022 around 3% and climbed to 7% by the third quarter. Now, in early 2023, mortgage rates have begun to stabilize. The 30-year fixed rate mortgage is floating between 6.1 and 6.2%. The 30-year jumbo hovers between 6.2 and 6.5%, and the 15-year is floating between 5.25 and 5.5%. This decline in rate volatility is now beginning to drive an uptick in new mortgage applications, potentially an indication of an active spring buying season. What we've seen broadly is stabilization of the supply and demand for capital. As transaction activity slowed following the rate peaks, rates naturally came down, and because the duration of your average real estate transaction is somewhere between 30 and 90 days, the time it can take for rate changes to stabilize throughout the market can vary. Saving for the possibility of extreme external activities in the market, like an unforeseen Fed move, war, who knows what, the new normal, as we say, appears to be where we are today. Transaction activity across market segments is beginning to stabilize, overall inventory growth is starting to level some, and time on market is starting to revert to historical norms. Really, what we've seen is the froth being blown off the top. And what the real estate industry and property owners are now needing to absorb is that new normal. And I don't say that to say it is easy, but we do have to be realistic and accept that today is very different from 3 months ago, 6 months ago, and most certainly a year ago. The whiplash that is caused by a rapidly changing market can make it very challenging to digest new expectations. For starters, negotiation on price is something all property owners are needing to accept. In just a few months, we went from multiple offers across virtually all areas of the market to, in some areas, crickets. Strength in a position of negotiation within transactions today needs to be carefully measured and calculated. Though not at high levels by historical standards, rising inventory levels are introducing options to buyers that were previously unavailable. Competition drives value, full stop, whether perceived or actual. Within the general market, every day I see situations in which a property owner has a value expectation from the peak of the market, but that value expectation, when coupled with the current rate environment, simply prices certain buyers out and leads to excess time on market, which then leads to a further dilution of value and unfortunately usually winds up with that owner having to sell for less than they would have previously if the expectation of value were more in line with current conditions. Now, the luxury market is a bit of a different story. Due to the market and data tracking component of our business, I'm asked often why it is that purchasing patterns within the luxury market differs from the general market. Now, I may be criticized by academic economists for the way I explain this, but I think it's the easiest way to wrap your head around. An economic concept called elasticity is what separates the general market and luxury market. Its most simple explanation is that it represents the difference between a want and a need. Housing demand is, for the most part, considered to be inelastic, meaning that it is in so much demand, it will always have a demand base. It is so important in daily consumer life that the price would have to be pushed to such an extreme that virtually all other spending capacity was eliminated before the demand for housing would vanish. It falls into the same category that we would place food and energy. It's just that important. This is why, as real estate supply has diminished over the past number of years, both value and the number of units absorbed has continued to rise. And why, when we saw rates jump as fast as they did, we saw absorption within general markets slow, but not stop. Even though mortgage costs rose by around 40%, we still saw activity. And for those who were unable to buy, they would still rent. The demand for housing is perpetual. On the flip side, if a good or service is elastic, when its price moves, the demand for that product can change significantly. Or said a little bit differently, because it is not a required good or service, its demand base can be more selective. This is not exclusive to real estate either. Luxury cars, clothing, jewelry, electronics, and so on all represent elastic goods. They represent something that, within the context of daily life, is wanted more so than it is needed. So the drivers of that demand are very different than with inelastic products or services. If we were to think about that 40% increase in mortgage costs with continued buying activity, just ask yourself, all other things being equal, if, say, a Ferrari over the span of a few months went from $200,000 to $280,000, would there still be demand? If a $5 million home suddenly became a $7 million home, would someone still buy it? Maybe, but maybe not. There is no certainty with a very elastic demand base. Let's look at Florida. In general, the state has been a domestic migration destination for the past few years. Its attractive landscape has captured an influx of new Floridians from the Northeast, Midwest, and West Coast regions of the United States, both on an individual as well as a corporate relocation basis. Broadly, this growing population has kept real estate inventory throughout the state, and here in Central Florida specifically, quite low relative to national statistics. A component of that is, of course, the luxury market. These pricing segments are much less rate sensitive than the general market. So as we've seen rates tick upwards, even though the cost of capital has been rising, we haven't seen outward demand destruction relative to the supply of luxury housing because there has been sufficient incoming demand. But here's the thing, that doesn't mean the luxury market exists as this playground of Shangri-La real estate with unlimited capacity. And this is where I see the need to be intentional in 3 areas of real estate, all with direct crossover between luxury and general real estate markets. In many ways, it is time to get back to basics, that is, the interwoven concepts of price, cost, and value. These elements, common across any asset or transaction, are often lost at face value, though they possess tremendous insight into greater strategy. Price is what you think it is. It is the sticker on the product, the listing price of a home, building, etc. What will be critically important throughout 2023 is what price represents, and that is competition. Within a growing housing inventory market, the addition of supply represents an option to the market. A buyer simply has more to choose from in both general and luxury markets. Many real estate practitioners today were not practicing following the 2008 housing crisis. Well, I'm here to tell you it was not a fun time to make a living in the real estate space. Deals were hard, lending was virtually non-existent, and property owners were in really bad shape. From that experience, I know that today it is the expectations that are set with property owners and buyers related to pricing, competition, and messaging that will achieve the best outcomes for all parties. As property owners or brokers, as much as we would like to sell for as high a price as possible, the market and demand exists as it does. The messaging that we send out when we list a home or a business or a building for sale is the first impression. Unless we can just command tremendous value, something we'll talk about here in a minute, we must do our absolute best to resist the urge to be emotional about our decisions and rely on clear and actionable information. The market will pay what it will pay, but if we fail to acknowledge the market when we are needing to sell, it will make us pay. Informed decisions when establishing pricing strategy and the competitive position we will have in the market will make or break how it perceives us entering into it. Next, cost. The dollars it requires to build or replace something. Again, fairly self-explanatory, but with a significant nuance in today's market. Supply chain issues, worker shortage issues, and market volatility issues. We could go on and on and on about various issues impacting real estate in one way or the other, but they all have played a part in driving cost. From lumber to copper to concrete to oil, the cost of materials rapidly drove new construction prices to all-time highs, which pushed more cost-sensitive buyers into resale markets, which further exacerbated inventory and value issues and created this self-perpetuating cycle. National home builders, both to take advantage of this value cycle, but also trying to slow down the pace of orders, then began auctioning lots or opportunities in later phases of construction, which served to only drive value even higher. New inventory was also held back to create greater scarcity and again, drive value. This continued ping-ponging value cycle between new home construction and resale homes, driven largely by cost, impacted the housing market tremendously throughout 2021 and 22. Today, lumber cost, for example, is not as out of control as it was 3 to 6 months ago, but steel cost is rising. So this idea of needing to navigate a landscape in which comparative conversations are being had, all while balancing elements of cost, time of delivery, and alternative, are likely only to become more active throughout 2023. A lot of this is starting to play out in the resurgence of national builder incentives. We're seeing $10,000, $15,000, $20,000 buyer incentives being offered to entice purchasers back into a new construction mindset. But a quick bit of consumer caution here. Just this week, we had to deal with an issue of a national builder offering a $23,000 buyer incentive. What wasn't clear or initially disclosed until a practitioner in our firm pushed for more information was this credit also included the buyer paying all of the builder's closing cost plus a $3,000 builder fee. I get that everyone is trying to make money, but really? So in this case, after all is said and done, the net effect of that $23,000 incentive was actually around $4,000. Now, that is still a credit, but it is very misleading. I mean, could you imagine if something like this were to get all the way to closing with the expectation of a $23,000 credit, only to find out that was not the case? What a disaster that could create. And just to be clear, though I personally very much prefer local or smaller, well-established builders, I'm not trying to summarily bash national home builders. They build a product at a price that could be challenging for smaller outfits to meet. But I just think that we should all work in an environment of legitimate transparency, you may say, not the smoke and mirrors of catchy but vague incentive offerings. Now, finally, the most important element, and that is value. Value is where the rubber meets the road and is representative of what something is worth or what someone is willing to pay. And the drivers of value are manyfold. What makes it somewhat complicated has nothing to do necessarily with the process of quantifying what something is worth, but how that worth is packaged and then sold. In the market position we live in today, right smack in the middle of a value peak period and a new value period, the ability to articulate value could not be more important. Within the context of real estate, when we undergo the valuation process for a home or a building or a revenue stream, we're looking at what activity in the market would justify a statement or position of value, which is generally a comparative process to whatever else may be happening. But in a changing market, that can be a bit of a moving target. Throughout 2023, the ability to clearly and convincingly articulate value and its relevance to the real estate product is key. If we go back to the idea of elasticity and how non-luxury segments of the market are pushed into renting due to cost of purchasing, those who are in the market to purchase are going to be looking for those clear elements of value. How well they are displayed throughout the course of selling will either draw buyers in or make it easy for the product to be lost in the soup of everything else that may be for sale. Keeping on this elasticity idea, the luxury market, because it has the luxury of being more selective, requires more convincing, more articulable value clearly demonstrated. The days of just throwing up a home or a building or a business for sale are over, and we have returned to a place where we need to diligently observe the 4 C's of selling: clear, concise, compelling, and convincing. As I've said previously, 2023 will present opportunity, exciting opportunity even, but there will be challenges, and it is incumbent on those of us in this space and this industry to make clear where paths to success are paved and where obstacles are likely to appear. Your price is your competition, your cost creates your alternative, and your value is your story. Whether a property owner or broker, understanding the value proposition of real estate and conveying that to the market will be the key to success in 2023. If you'd like for us to include any specific market information or topic of discussion, please let us know either in the comments or if you are receiving the weekly mail emails, simply reply to that message and let us know. Remember, please like, share, and subscribe to either our social platforms or to the weekly mail email distribution list. With that, I hope to connect with you soon.